Hello, everyone. This is Keith Engel again. Today, I'm honored to host some outside support rather than just our site in-house staff. And Regan Van Rooy, which has done quite a bit for us these days, independent. They're out there, I think on LinkedIn, you'll see the Mauritius. They're a firm that's located in Mauritius and in South Africa. They're here to assist us today. Lauren Hart is here. You'll see her bio in the back, but she's been from the illustrious firms of Weber Wenzel and KPMG. I would assume you went to KPMG before you went to Weber, but maybe I'm wrong.
I was at Weber's first, Keith, and then
really
recently at KPMG. Yes.
Well, and are you, Lauren, a lawyer or an accountant?
I'm a lawyer. Yeah, so I did my articles.
Okay.
I did my articles at Weber Wenzel, and then moved into the Big Four audit firm environment.
Okay, it's usually the accountants go the other way. So it's good to see tax lawyers. I'm a tax lawyer, so I'm happy. And then Claire Deuce, you are from AHR. I keep having trouble saying it. AHR Corporate Advisory. You are from Dubai, and you are originally from the UK, hence the accent. Correct. And you can say a little further about yourself if you like.
Yeah, no, I actually was a partner with PricewaterhouseCoopers. I was with them for just over 30 years as an audit partner and then an advisory partner. But I'm now providing advice through AHR Corporate Advisory Services to mainly SMEs and other business owners.
Yeah, no, very interesting. Okay, mainly with SMEs. So a lot of his family businesses and regional businesses.
Yes, that's right.
That's very interesting because I'm always curious as to what is what. That's there. And is you are a partner? Is there a few other people in the firm as well?
Yeah, so it's kind of I would say a top heavy. So unlike the Big Four accountancy firms, it's basically lots of senior people and very few junior people. So that means that we actually get our hands dirty doing the work, which is actually really, really great. Really enjoy working with clients, giving them advice based on the experience that we've got.
Yes, so it's a big secret because sometimes you want to know the names. Everybody just knows the Big Four, but increasingly there's the others. Now, Regan Van Rooy, there are quite a few partner level people. I don't know if they're partners, but it could be a partnership, but clearly there are quite a few, and it's quite diverse of corporate and others. And there aren't too many mid-levels. And so I guess you have a lot of late night work to do, Lauren. That would probably be what happens here. So anyway, it's just a little bit of background on that. And as I said, Regan Van Rooy is in Mauritius, and they are involved with regional issues. So that's why the UAE, and Claire is more in the UAE. And today we're going to talk about the UAE. I think many of you know that when it comes to Mauritius, they changed the rules last year and then the year before. They've been kind of fooling around, and it's getting people a little bit worked up, let's be honest. And there's some different webinars on that. And it's not as bad as everybody thinks. For example, trusts remain exempt, just for those who are still lost on that subject. But the argument was when Mauritius started fiddling with the system, the answer was we're going to go to Dubai. Well, now Dubai is fiddling with this system. And so they're fiddling with the system for the same reason that Mauritius is fiddling the system, is that our friends in Paris have caused lots of trouble ever since that damn Picardy book, which we should have it burned. That's my own personal view. We should never have allowed it into South Africa. But needless to say, our multinationals are in the spotlight, and therefore it's putting pressure on jurisdictions to do something. And the question is, well, have they succeeded? And means that UAE is not what it used to be, and therefore you want to just take all your money back to England or something like that. And so what we'll discuss today is the continuing viability of the UAE in light of the changes. So Lauren, I will turn over the show to you, and I will continuously interrupt, as you will see. There, Claire will join.
Your interruptions are most welcome, Keith. Thank you for the opportunity for allowing me to come and present to you on these exciting, although I think terrifying for some, changes that are about to be taking place in the UAE. So our presentation is all you need to know about tax in the UAE. Long ago, there didn't used to be tax in the UAE, so this is quite an interesting presentation, I think. So let's get started. So as most of you will know, an announcement was made on the 31st of January 2022 that the UAE will be introducing a federal corporate income tax regime, as well as some transfer pricing requirements. Historically, the UAE was a no-tax jurisdiction, and this monumental announcement has the tax world and all those businesses who might be impacted buzzing, as UAE structures may need to be reevaluated, But what we want to explore today is what does this introduction of the federal corporate income tax regime actually entail, and what is it that you should be considering going forward? So just briefly, in this presentation, we're going to be looking at the why, what, when, and how questions. So why was it introduced? What are the changes that this announcement envisages? When will the changes come into effect? And how will these changes be rolled out in the UAE? And then we'll end off the slideshow by sharing some of our initial thoughts and setting out what your business in the UAE should be considering and what your next thoughts should be. And as Keith mentioned, I'm hoping for lots of interruptions from Keith, as well as insights and input from Claire. As Keith mentioned, Regan van Rooy is based in Mauritius. I myself am based in Joburg, very far away from the UAE. So it's wonderful to have Claire on the call, who has more on-the-ground knowledge of what the practical impacts might be for the entities in the UAE. And yeah, we're looking very forward to some of your practical insights. Okay, so starting off with why. So historically, the UAE has been a tax-free location with an impressive and growing DTA network, and has therefore been an extremely popular holding company location. Keith asked me to have a look at what is meant by an impressive and growing DTA network. And quite amazingly, that the DTA network with the UAE is 137 DTAs, wow, many of which are in Africa, and growing to the point that most of those DTAs with Africa, or loads of the DTAs with Africa, were signed into force as recently as October 2021, many 2019, 2020, 2021. So we are seeing a focus on the UAE to expand its DTA network and to continue being that very attractive holding company location. I don't know, Keith, if you want me to just mention that. Yeah. In juxtaposition to this, we have Mauritius, who has 45 DTAs in comparison with the UAE's 137 DTAs. We've seen that many have been cancelled in recent times, and there are quite a few DTAs that are awaiting ratification, and many under negotiation, but with no kind of prospects to their conclusion. So who knows why the UAE seems to have a more favorable journey in their DTA negotiations. There's speculation that perhaps there's some pressure from the African Tax Administration Forum, or ATAF, which might be making the Mauritius Revenue Authority's lives a little bit more difficult. But yeah, that's just to illustrate how wonderful UAE once upon a time was, with its huge DTA network and zero tax environment. Yeah. But in recent times, over the last couple of years, UAE have been through a series of tax reforms to align themselves with international markets and diversify their state revenue. We saw this in January 2018 with the introduction of a 5% VAT rate. And in April 2019, the UAE introduced economic substance rules, as well as country-by-country reporting. The CIT regime and TP requirements that now have been implemented by the UAE are being implemented to meet international standards for tax transparency and to prevent harmful tax practices in line with BEPS initiatives. So there's a lot of pressure on the UAE to get in line with kind of the international movement towards the BEPS initiatives.
Yeah, that's part of the other one. So let me just ask you, Claire, a little bit. I mean, when we sit there, first thing it is, the Mauritius has got 45. I think South Africa, what do we have? Like 70 to 80 of them? We have quite a few as well. But when there was always this fight that the Mauritian treaties were always a little better. The South African ones were not quite as good. And when you look at the treaty network of the UAE, it seems to be growing. We're talking about Africa now. And so there were sort of two issues there. One is, well, the treaty network in South Africa isn't quite as good. And the second thing is, a lot of the African countries don't always listen to the treaty they signed on the ground. So even though you've got a treaty, you'll find that the revenue authority is a bit grumpy, and they don't like giving away the revenue because they don't really care. They just care about the revenue. They don't really care about the investment. And so, I mean, UAE, I guess my question is, when I was in Treasury, I used to see they used to make these requests a lot. They had like a processor sending them off, and they just kept asking. Because even South Africa has a treaty with the UAE right now, which when I was there as Treasury, I held off. I said, no. I don't see why UAE is going to bring foreign investment in this country. And I said, I'm willing to do it for the UAE pension funds. And then they just opened it up and let it go. But I mean, and then there's also the bilateral investment treaties, which I think Mauritius has a number of those. Those have stayed in place. I mean, do you see that the situation for the UAE is just everybody, they just got the right network and it's still growing, and, you know, and then are they followed? Do you find that they're respected in Africa, Claire?
Yeah, I mean, I think the UAE has done a fantastic job, and especially Dubai, in becoming an international hub for businesses. Its geographical location is fantastic. You know, the population within UAE is so diverse in terms of the number of people from different countries, different nationalities. Yeah, one of their key sort of strategies is to make sure that they network fantastically globally, to create those business links, and taxation is just a part of that in terms of being a great place to do international business, whether that's a hub for the region or whether that's really just looking globally. They're sort of again create themselves to be a great place to live, to work, and you know the big drive is to be, you know, easy to do business with. Yeah, but also wanting to be respected on a global stage for you know, maturing. So I think that there's a lot's been done in the last few years to mature their kind of business environment, satisfying various international sort of expected rules and regulations. So I think it's all part of that sort of broader strategy they have.
Yeah, and it seems like now they've gone in a similar way too. Country by country is not such a big deal because you have to do it for one country, you got to do it for everybody. So it's not like it's a big thing for them. But the economic substance rules, now Mauritius has got economic substance rules. You know, the UAE has economic substance rules. I mean, how hard are those economic substance rules? Because what they were trying to do is say, you know, if you have a CFC, you've got economic substance, and then the CFC rules won't apply. At least that's the US rules. I think Canada, I mean, not Canada, UK probably has a similar exception. South Africa has one. I mean, are there any real meat in those economic substance rules? And what is the meat in those rules?
I think, I think, Keith, you know, there's been a lot of pressure on the so-called tax havens to introduce economic substance rules to kind of put them in line with international best practice. But in essence, you know, they have been seen to be a little bit of window dressing, because at the end of the day, if you're not getting your substance right in low tax jurisdictions such as the Mauritius or the UAE, your risk ultimately lies in the higher tax jurisdictions. So they have introduced the rules, whether they're all that very important.
I mean, like Mauritius, the ones I know, maybe Claire can tell some years, you know, you have to have like a local trust, a local board director, and there's a whole bunch of registration requirements. And it kind of comes out to, you put a person or two in there and then you got it, you know, maybe a secretary, maybe you have to do more than a blast plate. That's what I've seen in Mauritius. It's a little bit more governance around there.
Absolutely. I think it's important to note that, you know, those so-called tax havens who have introduced the economic substance rules, they may have been doing it with the intention to stay off of so-called blacklists, etc. But substance is becoming more and more important, because if you don't have your substance requirements right, you know, the higher tax jurisdiction is going to come after you to try and pull you into their tax net. So it's definitely not something that you can ignore, the substance rules. And I don't think the days of just having a brass plaque on the door in a Mauritius office is enough. There's definitely additional requirements now to tick the substance requirements off the list. But yes, I don't think it's an impossibility to achieve your economic substance requirements in these kinds of locations.
Yeah, it's a bit of a burden. And Claire?
I was just going to say, in the UAE, it's early stages. But one thing that I've been in the UAE for just over 14 years now. One thing I've noticed that when things get introduced, they quickly get adopted and quickly get taken on board in the proper sense. I say so not just following a checklist or ticking a box to say yes, there's a plaque or I've appointed somebody, but actually doing it properly. So the UAE can move very quickly, but it's still very early stages, I would say, at the moment.
Yeah, and then I guess one thing too to note is that the South African rules require you to have a business establishment. So if you have a South African multinational with a CFC, if there's a business establishment, you'll get the business establishment exemption, which requires one manager and one employee and some suitable capital. But the key thing people forget is that you only get exemption to the extent the economic activity is attributable to that business establishment. And that means economically, as in transfer pricing attributable to, not as in legal attributable to. And I think that is the real problem for many companies, because I think the ones who are playing games, it's really very nominal. And if revenue service picked that up, they would have a good time in there. And I think that's one of those requirements that a lot of people close their eyes on, at least from what I can see. I'm not sure how with the British, the UK, they have a business establishment exemption also, don't they? In their rules. Yeah. And I think it came later. I'm not sure when it came in. It maybe came in somewhere between 2005 and 2010. So again, I don't know whether they have an economically attributable to test. The US has, I'm not sure if they have it either, but they have something more. So anyway, that's just a note, but there is some, but life was pretty good. So when you're advising from the UA, it sounds like you're mostly advising about UK tax or other taxes, or am I wrong about that? When it comes to corporate tax, yeah.
Well,
yeah.
Just to be clear, I don't advise on tax necessarily, because I'm sort of a chartered accountant and I advise on things like controls, business processes. But
I see.
A lot of the aspects that companies need to get right to be able to comply with the tax regimes is really making sure they can produce accurate information. There's good control. In terms of, once it gets to the details of the specific tax legislation, I kind of pass that on to the tax professionals. But I think from the UAE's perspective, I think it's helping businesses make sure that they are aware of tax, the issue, the things like transfer pricing. Many businesses won't really have had to think about it, or perhaps don't even understand what that might be. Have maybe large groups and they intercharge between them, but they don't actually, have any particular arm's length arrangements or documentation in place. So a lot of it is about, what I would say, just getting the basics right. So that's generally where some of the advice that I would give is focused on, rather than the specifics of which jurisdiction you want the profits to be made, and sort of how can you make sure you optimize your tax bill.
But we found is what you do is actually extremely important, because I grew up in a day, and you can see I'm a little older, and that generally the advisors like myself would give advice, put it in the drawer, and then the client would just do whatever. And even though the advice might have been correct, there was no compliance follow through. The paperwork was never. So you often had a good opinion followed by a sham in fact. And so unless you get the paperwork right and get, some of those things, and transfer pricing, of course, being the biggest risk, but the other ones are there too. And as you said, if I have an intercompany charge from a group point of view, from an accounting point of view, I don't really care. It's an elimination. It's an intergroup. But from a tax point of view, you've got to transfer price, or you've got to get the records right. So that's really where the game is at, making sure you can get that down. It's not, I don't know if it's hard to do, but it's important to do, and you've got to make sure somebody's on top of it. So I think that's critical. Okay, next slide.
Okay, so now we've got a few slides coming up looking at what the changes are likely to be, and what information we've been given thus far that indicate what those changes will be. So the UAE will be introducing a standard statutory tax rate of 9%, with an exemption applicable on taxable profits up to 375,000 dirham, which is circa 100,000 US dollars or 1.5 million rands. And this is in support of small businesses and startups. Further to that, large multinationals who fall under the scope of Pillar 2 project will also be subject to different tax rates. That's all that the announcement kind of gave us. But in the context of the global minimum effective tax rate of 15%, as proposed under Pillar 2 of the BEPS project, a large M&E refers to an M&E that has consolidated global revenues in excess of 750 million euro per annum. So whilst we don't know what the different tax rate is based on the announcement from the Ministry of Finance, we do anticipate that it's likely to be 15% for those large M&Es meeting the specific criteria set out with reference to Pillar 2 of the OECD BEPS project. So I've included a little checkbox below. It's not really a sliding scale, but it's just showing that there will be a complete exemption from taxable income. So 0% applicable to your taxable profits below 100,000 USD, 9% on all taxable income above the 100,000 USD mark. And then should your entity qualify as an MNE under Pillar 2 of the OECD BEPS project, there will be a different tax rate applying, and we believe that that's likely to be 15%. Now, we've had much debate amongst ourselves in preparation for today's slides on why 9%. It seems like a bit of an arbitrary number. Why not 10%, for example? But is it arbitrary? And Keith, I think you wanted to maybe chat to us about why you think 9%.
Here's, what it is that the way it goes is that the global minimum rate is most likely to be 15. That's when you look at those papers. I must say that reading those papers, I'm not sure, you're an international expert, Lawrence, so you read them or you tried to read them, you just die. So we've been very lucky in the site because we use Lee Corrick a lot. It makes it easier to understand it. I've had a number of transfer pricing conferences and he's really helped us through it. But the number is probably going to be 15% based on all the newspapers we're hearing. It's 15%. It makes Ireland unhappy, but it's tolerable, right? Mm-hmm. And there might be one or two others they could live with. The Mauritius rate is 15. And so that was the question. Why not a 15% rate? If you're trying to escape, that's really what this is all about for UAE. They're trying to escape the new rules so they don't get themselves into trouble. Then there's the 9%. There's another rule in the Pillar 2, which talks about the subject to tax rule. And that if you are not subject to tax, on the payee is not creating a subject to tax situation, then what can happen is the treaty will be pushed away. So even though you have a treaty, the treaty will not reduce withholding tax rates unless there's a 9% rate on the other side. So they went for the 9 to make sure the withholding tax is not the treaty reduction on the withholding tax. So the worst thing you want to have is like one of these French African countries where they have a withholding tax rate of 20%. And then you put it down to, you get it down to 10. And then all of a sudden they're facing a UAE charge of, 0. And then they go, oh, the treaty doesn't apply. And now the rate goes back to 20. That's my understanding. So even though the minimum rate is 15% as a general rule, the subject to tax rule is good enough for 9. And then to go further, I'll ask.
Quite a lot of the pre-reading I did, certain countries have their own internal legislation which looks to, a tax rate of at least 9% when applying access to treaty, etc. So that's maybe something else that they were thinking about when we're making it 9%, so that they always tick the box of at least a 9% tax rate. Okay, which country has done that? I'm just curious. Do you have any recollection? I'm now catching on the spot. Somewhere you have me on the spot. I think it may have been the Netherlands. Okay. That would sound right. Yeah, I think it was the Netherlands. I stand to be corrected, but I read that
So the point is, but it's a lower than 15. Now, the withholding tax is important because treaties are about withholding taxes. So if you pay money out of Kenya or Nigeria, the big thing you're trying to do in that treaty is if it goes from Nigeria to UAE, your problem is you want to reduce that Nigerian withholding tax. That's the main goal of a treaty. And if they don't have the subject to tax of 9% on the other side, well, now no treaty relief and you get the full rate without regard to treaty. So that's why I guess the most important part of a treaty is really the withholding tax reduction, at least in my mind. So, I mean, Claire, in your experience, and this is not a deep tax question, I mean, the UAE treaties, I mean, what rate do they get them down to, typically on things? Do they get them down to a 0, a 5, a 10, a 15, a 20? What rate does the treaties generally bring things down to for African countries?
Unfortunately, I don't know that information. I'm sorry, but
okay. I mean, let me say this, that generally, from a South African point of view and from a Mauritian point of view, most of the Africans start out with a UN approach. So UN approach is usually 10%. Mm-hmm. And that's usually the number they like. That's right, Lauren. I mean, that's what so when the treaty applies, they get you down to about 10. Sometimes the treaty will get to 5 or 7.5. In Zimbabwe, we had some good negotiators there. Charles McColl and Latando Movovo, if they're out there, they negotiated down a little lower. But usually the Africans go for 10. And some of the French guys, they'll start out with 20 and want to stay at 20. Now, and a lot of the African withholding rates are around 10. So it's kind of a muchness in here. I mean, if the 10 rate, if it's already there,
what is the big
then this rule really doesn't have much, this 9% rule really doesn't have much of an effect, because you'll get a 10% rate and that's that. So you just want to make sure that you can keep it at 10. That's generally, but getting money out of Africa is not like getting money out of Europe. When you get money out of Europe, they believe in an OECD export neutrality treaty. And so you'll see in a lot of UK jurisdictions and US, when they want a treaty, they want the source country to go to 5 and 0. Mm-hmm. That's what they're going for. 10, not exciting. Worse than 10, I don't even know why you're making it. So there's that. Other question here is about netting. It says 100,000 is exempt. That's the 0 rate. Okay. And usually they don't have as much cross-border work. But I mean, I guess, have you seen, Claire, from an accounting point of view, do a lot of these companies basically have a 0 rate because their revenue and expenses offset each other, just from an accounting point of view?
Yeah, I mean, it depends on, there are so many different types of entity that can be doing business in the UAE, from sort of limited liability companies, free zone entities, sole traders, freelance licenses. There's so many different licenses and options that organizations can have. When you do have foreign investment, foreign ownership, generally, the profit is minimal, because in terms of that's the target, to make sure that the profit is minimal. Especially where you have situations where you have local Emirati ownership of 51%, foreign ownership of 49%. The target really is for the company to have a tiny amount of profit, and that's all, just to make sure that things can tick over and everything to be almost cleared out after every year. So that tends to be the target that you see companies working towards.
Interesting. Now, do they clear it out with expenses, or do they clear it out with dividends?
Ideally with expenses, in terms
of
charges. Yeah.
So this $100,000 exemption might actually mean a lot. You net out, because they might be subject to a 9% corporate rate, but they're netting out. And again, I mean, the purpose of UAE and for a lot of multinationals is really, and this is what I think a lot of the governments don't understand. Sometimes it's not about a 0 so much as trying to get away with anything, but trying to just move money from one place to another without another charge. Because remember, there's two levels to this thing. Let's say you do your business in Kenya to 30% rate. Then you move it to Dubai, and then you move it out. You don't want to have a second tax for moving it. That's what they don't want. That's I would say, the tax minimization technique, which is sort of like a group concept. If you move in the group, it's free. Where it gets aggressive is if the UAE tax system is working with the Kenyan tax system to strip out the Kenyan tax base. That's where the evil is. And I often think that government wants to go after both, but really they should only worry about the source country being stripped.
Yeah.
You know, I'm not if you have anything to add to that, but so the zero might be something. That 100,000 may help a lot because it is subject to tax at 9. Now, again, we haven't had the full definition of subject to tax yet, right?
No.
I mean, yeah. So you don't know what that means. That's there. Okay, I'm not sure if anybody want to add anything to that. Yeah.
No,
Just
so I think
one thing. Yeah, hold on, Claire. One thing, let me do it. Just Lauren. Claire, when people pay out an expense, what are they paying it out? Is it royalties, interest, or service fees? To get the, yeah.
I guess a combination probably of interest and service fees would be what's being paid, more royalties, yeah.
Yeah, okay, that's interesting. Okay, sorry, Lauren.
No, not at all. So this slide just illustrates what the tax rates will be. So from your 0% to 9% to potentially 15% for large MNEs. And now we just look at a little bit more of the nitty-gritty. So the corporate tax payable will be calculated based on the accounting net profit reported in the financial statements, adjusted for credits and allowances. So they've got quite generous credit and allowance regime. We are waiting a little bit more clarity to be provided on certain elements of it, but what we can see is that foreign taxes suffered on UAE taxable income will be allowed as a tax credit against the UAE tax liability. And businesses will also be allowed to utilize losses incurred from the effective date of the implementation of this corporate income tax to offset taxable income in subsequent financial periods. Tax losses from one group company may also be used to offset taxable income of another group company, provided certain conditions are met. We unfortunately don't have much more information than that at this stage, so we're just waiting for clarity to be provided on what the group loss utilization rules will be. There also are numerous exemptions envisaged in this new corporate income tax regime. The first being that the existing free zone exemptions will continue to apply where all regulatory requirements are complied with and where the entity conducts no business with mainland UAE. So UAE free zone companies should in principle continue to benefit from their tax-free status and therefore shouldn't really be impacted by this new corporate tax rate, at least for the duration of their tax holiday. Keith, I don't know if you want to chat a little bit more about the credits and free zone exemptions, which we touched base on earlier.
Yeah, let me just say something first. What is interesting here is the corporate tax base is based on accounting net profit.
Yes.
Now, I've actually argued that that's a good tax base rather than having tax as its own thing. Okay. Now that's a violation, a heresy. I used to be a professor, so to say something like that is a heresy. But I always felt that generally you should do accounting net profit with adjustments because that's how you actually do compliance. So at least for you, Claire, you don't have to learn a whole new tax act if they're true here. But again, they're not that interested in this thing, so they're not worried about the holes in the system. But the one question I'm having for you, so is the accounting net profit. Before we jump to things, these UAE free zones, what do these look like? And generally, if I'm a South African, which ones would I likely use? Assuming I'm a multinational, because I think most of these people here are going to be the bigger players, and the little guys are not going to go to UAE. Yeah.
I think it depends. I was just looking up earlier that there are more than 40 different types of free zones in the UAE. So the UAE comprises of 7 emirates. So there are free zones in each of the different 7 emirates. And kind of the key distinction between them would be there are some free zones which are, I'd say, kind of gated free zones, so more like the ones that are closest to ports. The largest one would be the Jebel Ali free zone, but Ras Al Khaimah, Fujairah, Abu Dhabi also have their gated free zones, where they're typically used by international groups that want to have foreign ownership, and they deal in goods, so physical goods. So they have storage areas, warehouses. They can do certain processing in their warehouses, and at that point, the goods have not actually entered the UAE. They're effectively offshore. So those free zones would be typical in terms of being able to have this exemption from corporation income tax, because the profits they would generate would not be from activity on the mainland within the UAE. But there are a whole load of other free zone entities or other free zones which are not gated, which were things like for services, for internet, different activities, different locations that are not gated. And effectively, if a business conducts all of its business within that free zone, any profits generated from that activity would be exempt. But in most cases, organizations set themselves up, especially foreign investors, to make sure they can have 100% ownership, but then actually transact and do business with the rest of the UAE. So the profits they generate from that activity would not be exempt. So they would be subject, I understand, to tax in this situation. So I think it's not as simple as saying if it's a free zone, it will be exempt. Yeah. We need to understand what the free zone is. And as I said, many companies set up in a free zone purely because they wanted to have 100% foreign ownership. Whereas a year ago, the rules now have changed in the UAE that you can have an entity, a limited liability company with 100% foreign ownership. So a lot of groups and organizations are thinking, well, that's quite attractive, but how do I change from where I have been in the past to this new opportunity? It's not quite as simple as that new company, transfer everything across. So there's a lot of considerations that companies have, but that has driven many international businesses to set up entities in free zones, mainly for that 100% foreign ownership, which is now no longer a requirement. So that's a factor to consider even before corporation tax. But I think it's more about looking at, where does that entity generate its profits from? Is it activities within the free zone or across the wider UAE kind of business?
Which is what you're getting to is where the entity conducts no business. So the guy who's in that free zone, that he is conducting no business with the mainland.
Yes.
He might be there, but he's not in the mainland. Yes, Lauren, I interrupted you.
No, that's exactly what I was going to say. I think for the free zone exemptions to continue applying, for those free zone companies to have a tax-free status, they can't be seen to be conducting business with mainland UAE. And this announcement from the Ministry of Finance also further said that it's only where all regulatory requirements are complied with, and there hasn't been any additional information provided on what those regulatory requirements will be. So I think, it's we wait and see how the free zone companies will be impacted, if at all, by this introduction of corporate income tax.
So I think it'll be quite a big shake-up. So I think the 100% foreign ownership is a shake-up to the free zones, as is corporation tax, because what's happened, each free zone has its own sort of implementing rules and regulations. But in most cases, they say that you as a free zone entity can only conduct business in the free zone. But in reality, people set up an entity in a free zone because of the 100% foreign ownership and because of the lower cost setup of a company. And then they transact across the UAE, which is kind of widespread, known about, but it's not penalized necessarily by the authorities. So the point about, whilst they're complying with the rules and regulations, that might be referring to the fact that the rules and regulations actually say they should be conducting their business within their free zone.
Yeah, no, it's interesting. So it's been soft because, this local ownership, in South Africa, it's BEE, but it's local ownership. And it's not anything to do with BEE as an issue, but the bottom line is if you're a foreign investor, you don't want to share ownership. That's not what you do. If you're a multinational, whatever, you want 100% control. It might be the nicest people in the world, but you're not looking for a partnership unless you need one. And so the bottom line is, I'm sure people say, well, to the extent I'm going to have a forced partnership, very few of us are going to make it worth our while unless the profits are really super. And that's that. So it's interesting to show how that's spread across. But it's also one of the other questions I've had is when you look at UAE free zones, the thing that I've seen a bit of, and that's just maybe my experience, is that there are UAE service providers. So what I have seen is this, where the UAE company has a bunch of employees, but those employees don't work in the UAE. That what they do is they are allocated across the region. And they are just sort of a central labor management hub. And I've seen that. Have you seen that, or am I just only getting one or two exceptions?
Yeah, I think it's it has been, I'd say, complicated, but the whole structure of the corporate structure and who can employ how many people, what nationality, what particular job specification. It was set up on the one hand to kind of protect the local population, to make sure that certain activities were preserved for local Emiratis. Things have then moved on from there, but there's still some legacy issues in terms of you have to be a certain type of company with a certain type of registered activity to be able to employ a certain number of people with this particular skill set, even potentially this nationality and this gender. So there's a lot of control and regulation in that area. And when you look at the way that companies have started to employ people, for example, if one company has permission or authority to recruit 100 people and have visas for 100 people, but actually the activity really is being driven by another company, changing employees from one company to the next is not that straightforward. So it's quite common, especially in the multinational groups, to set up a number of entities. Maybe one or two might have employees, but other entities might actually then conduct business and activities, and then so there's an element of recharging of employees across one company to the next.
Yes, I mean, I guess the thing is, if you have to have a bunch of guys being deployed all over the place, where you just want them in one company without having them to be going through that, I guess the problem is they might have like cross charges. So it might be that the Dubai company pays the employee, but then the local source country's got to pay the UAE company. And then you'd have income, service company income, followed by service company deduction, which would get you to the net of zero. And you're saying there are quite a few of those? Is that if I'm hearing correctly?
I would say quite a lot of examples, especially from multinationals setting up their operations in the UAE, because they would have taken advantage of whatever the structures were available at the time. And the UAE has moved quite quickly in changing a lot of the rules. And to try and change your corporate structure every time could be quite challenging. So I think the introduction of the 100% foreign ownership and then corporation tax is a big kind of push and a drive. It's now worthwhile for those multinationals to really look at how they, are they structured in the right way? Do they need to, to rethink that? But then you can't just consider tax. You have to consider all the other factors that are coming to bear on it.
Yeah, well, and it's a small note, but I've always said that tax incentives only work if properly coupled with regulatory relief. If the regulations are bad, they're not going to take it like it was zero. So, but the bottom line is if they don't like the regulation, they go, the regulatory price is too high. And I think a lot of times our government, South Africa, doesn't seem to get that. So like special economic zones we give you tax relief, and we give you a bit of tax relief, customs relief, and some VAT relief, but there is no regulatory relief with it. So people go, well, I need the regulation. China, when they did their SEZs, I'm told they did the regulation and the tax. And that's because they were trying to get around communism. I'm not sure if that's correct, but that's what I've been told. So the UAZ zones, so there's quite a few that can work. The losses is an interesting rule. And again, I think South Africa had something like this, but it might have been pulled back a bit. And then the credits, we have to know about tax credits. So Mauritius, I think Lauren knows, gives you indirect tax credits. You just don't get automatic ones anymore, right? And if you're pulling money out of Africa and it's an indirect tax credit, well, that's talking about, let's say you pull out of Uganda for 30. Well, the Mauritius rate is 15. So you're going to wipe out your local rate if it's a dividend. Who cares? It's nothing. It's annoying. You have to do the mechanics, but you can do it. So you're not going to have a second Mauritian tax there. Well, we're not sure. It just says tax credit. Typical tax credit probably is about 10%, because that's probably for the African countries anyway, because they don't go down much further than that. But it's not as bad as that original slide. We're getting some relief here. I think that's the point.
And more relief is holding on for the next slide.
Yes, go for it.
So further relief that's envisaged under this new regime is that there will be no withholding tax on domestic and cross-border payments, which is good news for pure holding companies in the UAE. Furthermore, the following categories of income will be exempt from corporate income tax. So that would be your capital gains, dividends received by UAE businesses from qualifying shareholding, and then qualifying intra-group transactions and restructurings. And then lastly, income from the extraction of natural resources, which income will be remaining subject to Emirati level corporate taxation. If we look at those first three categories of income that will be exempt from CIT, I think, well, firstly, we await further clarity or guidance on what exactly a qualifying shareholding means and what qualifying intragroup transactions will entail. But I think we anticipate that there will likely be introduced a participation exemption or similar principles that are commonly seen in the international market to facilitate these exemptions. Yeah, and I think when you look at all of the exemptions, the free zone exemption, as well as the fact that there's no withholding tax on domestic cross-border payments and those various exemptions from corporate income tax, despite this introduction of corporate income tax, your investment holding companies should still be able to achieve tax neutrality through this proposed regime. And yeah, the absence of withholding taxes on domestic and cross-border payments, capital gains and dividend exemptions, and also those generous foreign tax credits, as well as deduction and tax loss rules, means that there's not necessarily any need to panic for many types of entities that will be set up in UAE for holding companies.
Well, I think the big thing is the withholding taxes, because that's the biggest problem with an intermediate jurisdiction. I know South Africa, we tried to be an intermediate jurisdiction because we have a lot of banking and financial services here. The goal was we would have money, we would be, owning a lot of African companies, and then what would happen is it would push through, and we didn't want to have another layer of tax. But the key thing that kills you is those cross-border withholding taxes. Yeah. You're not making profit with withholding taxes. You're just moving it around the group. And that's what the companies really don't want. They don't want to be taxed for just moving it around the group. Now, some of them don't want to be taxed even when they actually are actively earning the service income from general clients. But a lot of them go, it's fine, I got the one level of tax, but I don't want to get that second tax for moving stuff around, because that's non-commercial. At least when I'm making real money, I'm matching it with the taxes against it. But if I'm just moving money around, now that's just bad, because I'm not really making real money anymore. And so that's where it goes. Now, the only thing I do wonder in this thing is, look, they say there's a 15% or a 9% minimum. Why does a free zone get around it? Why do some of these things get around it? And then you look at that 500-page OECD document, and they do seem to suggest that there might be some relief for active trader business or other things. So the question is, do these incentives or do they get sucked into the 15% minimum rate? And I'm not sure if the rules are detailed enough, but I'm assuming they would want to attack it. But again, there's ambivalence. So I'm not sure if you want to add anything there.
No,
I think we just have to hold on tight and wait for clarity to be provided, through the BEPS initiative, as well as the UAE local legislation that will come through. Yeah.
You said something, Claire?
I was going to say the same thing in terms of it's relatively typical in the UAE to have announcements about things. And you're desperate to find the detailed documents that explains everything, but you never do. It's very kind of high level, impactful, very good PR, and then you have to wait for the detail to come out.
Yeah, and that's also, I mean, South Africa, we complain about that, right? We don't have the detail. How can you announce it? And, that seems to be the average. It's what it is.
Good to hear that it happens elsewhere other than in South Africa. Okay, so that's welcome. I think that the last change that was introduced in this announcement is that UAE businesses will now need to comply with OECD transfer pricing rules and documentation. I think this was one of the scariest announcements for many, also driven by the OECD BEPS initiatives. Everyone around the globe is introducing TP rules, etc. And I don't think there's need for panic. If you're doing cross-border, if your business is undertaking cross-border transactions with related parties, the other jurisdiction will likely need the transfer pricing documentation to be in place anyway. So now it's just a mirrored approach with the UAE. But yeah, so the transfer pricing rules are mandatory and may also be applicable to domestic transactions. Intercompany transactions will now need to be undertaken at arm's length and should be supported by appropriate documentation. And businesses will need to reevaluate their current arrangements and assess the impact on both cross-border as well as domestic transactions. So that's the last change. I think the next big question is, when are all these changes coming into being? And the UAE CIT regime will only become effective for financial years starting on or after the 1st of June 2023. So they have given quite a lot of time, circa 18 months, for UAE companies to get their ducks in a row and understand the changes and how it will impact their business, and also make necessary changes to their systems to support those changes.
Well, so I think I agree with you. I think, look, you have to do a transfer pricing documentation everywhere, right? So even right now, the UAE will probably be a residual one, but you're having to do it for everybody they own or they're owned by or they're dealing with in the group. So now, in order to make sense of it, you've also got to do it for there because of all the other jurisdictions. So from a compliance point of view, it's not much worse. The only danger is once you put in a transfer pricing, you could face some uncertain risk. Now, I'm not sure, Lauren, whether you've dealt with this in Mauritius or not, but about a year or two ago, there was the Mauritians started to actively pursue transfer pricing. And a number of times the issue is, where is the Mauritian markup? So if I pay management fees to Mauritius, and then Mauritius then pays those management fees back out again, well, why aren't they capturing some profit? And therefore, there is value to be taxed within that thing.
Yeah.
And so that became an issue of litigation. I think ultimately the Mauritians backed off on it, but you could find that there's an expectation that you can't just have a back-to-back expense without any profit in between. And then that profit would be eaten at 9%. And nobody wants that additional charge.
No.
So there is a risk in there. Now, again, if they don't really enforce it the way Mauritian did for 15 years, it goes back and forth and who cares? Or you say, well, look, we didn't add that much value to it because it went in and out. So there's a transfer pricing analysis. We'll give you a peppercorn, 1%, and then we'll get 9% and just shut up and accept it. So you could try that game. But it is something to think that even if they don't enforce it at the beginning, they might suddenly want to enforce it a little.
Yeah,
So
especially with their efforts to diversify their in-state revenue. So that might be their one, the one finger in the pie that they intend on.
And the problem is, once you have revenue authorities there, you see right now you don't have any there. Once you're there and you give a guy a job to raise revenue, it is his job to raise revenue.
Absolutely.
Even though UAE is friendly and they get it, that guy doesn't get it. That guy goes, well, wait a minute, there's some money and I can reach my target or something. And you start. So there is going to be a little bit of a net profit margin in there. And probably if you're going to just keep things good, you not, instead of going all in, all out, you may want to capture just a little bit so that it's assessed and the revenue authority's kind of stuck with what you've done. But that's a different strategy. I mean,
Yeah.
I'm not sure if I'm making sense, but I'm not sure if you've seen that kind of game, Lauren, or not. I'm not sure what Claire has seen, but it would seem that there is a bit of risk here too. You don't want people coming back on you. That's there. So that's that one. The other issue is, Claire, now, are the revenue authority, are the Treasury, whoever's doing these rules, because the revenue authority is really new, are they fairly open to discussion? Is there engagement with the private sector, or they just operate behind a wall and make an announcement?
So yeah, the Federal Tax Authority, they will have come up with the legislation based on interactions mainly with lots of consultants, perhaps big four firms.
Yeah.
Would have provided input. They're very good at acknowledging they've not done this before, so they will actually seek and take advice from organizations who've got experience of that. So they'll have not sort of done this in isolation. And also that the way of announcing things is also their way of getting some feedback and public opinion. So they announce something that's not very clear. That will then drive lots of queries, lots of how will it work in this situation? What will happen for that? Then they will use that to then shape the further guidance, but also shape some of the, if not all the decisions have been made, that will shape their thinking for the next set of, it might be the next, when they issue legislation, then issue further guidance, clarifications. That's kind of the style of how they'll take on board opinion from the private sector, as well as getting consultants' advice.
I mean, which I think is important. I think it's a small issue, but a big one that I don't think governments get. Is the government willing to listen? Is it a business-friendly government? And the first thing is sometimes the attitude. And that's where I think Mauritius has kind of been up and down, but South Africa has definitely been a problem, that there's a feeling that once the rule is set down, we don't want to listen. We're going to just keep it that way. And, that willingness to listen is part of an ease of doing business. I can trust you. You're not going to do anything crazy. And so that's, I guess, what they're doing here. These are the initial elements of it. Now, the one problem here is you'll see their exceptions. And like the 15% rule. So if do you have an active trader business? Do you have a participation exemption? So one of the questions is, well, while this rule, there's a 9% rule, it's fairly porous. The question is, will the OECD accept those holes and not do anything, or will they? So there's that little piece. Lauren, you wanted to just do a little bit more here?
Yeah, so this is just our last question for today, and that's how the CIT regime is going to be rolled out. So businesses that are subject to UAE CIT will be required to file a income tax return electronically. Yeah. They have allowed for fiscal unity. So UAE companies will be able to form a fiscal unity for corporate income tax purposes, effectively submitting a consolidated return. And the Federal Tax Authority will be responsible for the administration, collection, and enforcement of this new corporate income tax. And they do envisage imposing penalties for non-compliance with the CIT regime. Yeah. Our initial thoughts, and then we'll look at what your business's next thoughts should be. Just to close off from our side, whilst the new regime may have come as a shock, the international arena's focus on BEPS and the levelling of the playing field has made it absolutely necessary for the UAE to implement these changes over the years, culminating in this most recent introduction of corporate income tax and transfer pricing requirements. Whilst the CIT may apply to your business, the rate is still quite low, and that makes the UAE, or continues to make the UAE, an attractive destination for business and investment. The exemptions from corporate income tax further solidify the attractiveness of the UAE, and might even result in certain businesses not being subject to corporate income tax at all, like those not carrying on business in the UAE or those qualifying for the various exemptions. An important next step is to determine whether the corporate income tax will impact your business. And it is our view that many entities may escape the CIT consequences pursuant to the introduction of this regime. They may need to still fulfill the compliance obligations pursuant to the regime, but whether it will actually have an impact on a corporate income tax level may not impact on your business. So I think importantly, we await clarity, and I'm sure many entities await clarity, tax advisors, the likes of Claire's advisory firm, etc. We need this clarity from the Minister of Finance on the regulatory requirements which are to be complied with for example, the UAE free zone exemptions, as well as the criteria to qualify for the exemption from CIT on your dividends and intergroup transactions and restructurings. And I think importantly, we have quite a lot of time before the CIT regime is implemented on the 1st of June 2023. And before that implementation date, we just feel that businesses in the UAE need to bear the following in mind and be asking themselves the following questions. So one, does this CIT regime apply to your business in the UAE? If so, what rate will be applying to the business? You know, is it the 0%, the 9%, or the likely to be 15%? And what is the actual impact on my business and overall structure? Do any of the exemptions applicable to the free zones apply to my business? And are we conducting our operation in line with those free zone regulations? Are related party transactions in compliance with the arm's length principle? And what do we need to do to be considered as TP compliant? Do we have numerous entities in the UAE which could potentially qualify for fiscal consolidation, thus reducing the administrative burden? And then lastly, and probably the most importantly, in the next kind of year and a bit, is what system updates or ERP updates need to be implemented to position our business to apply these CIT rules. Do we need to start having conversations with your UAE business and staff to ensure a smooth transition to the new regime? And that's all from my side, Keith. I've included in my final slides, and we can chat a little bit more now, but I have included a brief bio on myself, and also about Regan van Rooy, the boutique tax advisory firm that I work for. And right next to that is some information on Claire from AHR, with our contact details should anyone wish to get in touch with us for more information about these changes going forward.
That's interesting. And so, yes, and as I said, you're both offshore firms a little bit, because Regan van Rooy, Keelan's starting Mauritius, so there it's got a Mauritius South African leg, and you're also, Claire, in the UAE. Where is this? Just from your point of view, because you're in the UAE now, is there a lot of outrage in the UAE? Is they very upset about it? You got a lot of clients calling. What's the general mood over there? You know, because Mauritius, there's been a sky is falling, but then it's okay. It's been back and forth. Have they managed this well? What is the view?
I think overall it's been taken very positively, which could be a surprise, because you've got no tax, and then suddenly you're going to be subject to can be subject to tax. But it's really a demonstration of how the UAE is moving in terms of progressing the business environment, really wanting to demonstrate it's a reputable international place to do business. So it's really wanting to make sure that it sort of, as it ups its game in terms of regulations, all along that path of being an attractive place for businesses to have their base or their head office or regional office. So all of that's really positive. You would have thought that potentially some of the local businesses, the Emirati-owned businesses, might be concerned because they're already here. It's an attractive place for them, and they're now going to be taxed. But it's also seen as a way of investing in the further development of the country's infrastructure. So what you get in return for the tax is you get the funding to be able to, for the networks, the infrastructures, that ease of doing business, the platforms that are available. So I think even the local businesses see that as a positive step. So generally, it's positive. I think if they'd announced personal income tax at the same time, that would have had a very different feedback. But I think at the corporate level, it's seen as, well, this makes complete sense. So most people are fine.
I think it's showing, I guess, that maybe when Mauritius had a little bit of trouble because it's more distant maybe from the OECD. is that this proposal is limiting the damage. It's not going crazy. And again, you're right, UAE has a lot of real infrastructure. So now when you live there, you're getting a lot of value for your service. You might be getting a lot of heat, but you're getting a lot of value for your service. And when you see UAE, it's a nice place to live. And that's why a lot of people, it's a metropolitan kind of place. And so, but again, also, if you look at it, it's a net 100,000 exemption on the net. They've got a lot of little holes there. They're trying to see if they can keep it that rate as low as possible. They're not looking to jack it up more than they absolutely have to. Yeah. And that makes a big difference. And then just to close, it seems to me that the corporate rate being what it is, not such a terrible thing. And that as long as the individual income tax rate remains fully exempt. And then the trusters also and the foundations are exempt. I think I don't know if they have trust, but they have foundations, right? And do they have trust in UAE?
It's not as commonly used here compared to other countries, no. But
do they use foundations a lot over there?
Again, not as common compared to other.
So most of them really use the company as part of the family planning because that's what you do. But then the individuals, is there a fear that they're going to put a tax on individuals, or no, the VAT's fine?
I think the reason that so VAT could have been an option of increasing VAT rates, but that would have really dampened tourism visitors in a huge sector, which is why I think corporation tax at an appropriate level. I wouldn't be surprised in a few years' time if income tax might be introduced, but effectively it's a little bit of a sliding scale because the people will earn a certain amount, but it's tax free, whereas they might have earned a higher amount, but it gets taxed. So it's almost doesn't really matter where that money comes out, and making it simpler, having it through the corporates bearing the cost. It might be a more of a simpler option rather than introducing an additional type of tax.
Yeah, well, then also if you're going after an individual, now you're going to hit all the locals living locally. Yeah, there's not just a lot of these companies; it's more for the multinational. Yeah. So, any thoughts, Lauren? If you've been hearing a lot, and then how's Mauritius going over there? Are people very worried about Mauritius, or they're also calming
down? So, if I answer the first point in terms of what are people sort of worried about? What are they doing? I think it's a great. I'd say they should see it as an opportunity rather than a hassle. But the 100% foreign ownership plus corporation tax, it's an absolute kind of must for especially multinationals or any business with any international interactions to review, how are they structured? Why do they put these structures in place? At one time it might have made sense, but to understand what, so it's really going back and having a bit of a refresh on why do they set up the companies in this way? What was the benefit, disadvantage? Where are we now? Where are our customers? Where are our suppliers? Where are our people sitting in which companies, which entities? What makes sense? So it's a great opportunity to kind of have that almost like a blank sheet of paper and say, if we were going to set up now, what would be the right sort of the right structure, right approach, and trying to understand the legacy history, and then seeing how hard it is to move from current situation to what might be a more optimal position. So I think bearing in mind all of those different factors.
That's interesting.
And I think similarly, Keith and Mauritius, things are definitely coming down. These initiatives are impacting almost each and every country across the globe, and the days of tax havens and earning tax-free very numbered. So I think with this global movement towards the BEPS initiatives and preventing harmful tax practices, it was just a matter of time before Mauritius closed up a little bit. And I think it's becoming more accepted. There was obviously outcry at first, but
well, I think just my view is right now, this is sort of the high watermark of BEPS. My feeling is, to be honest with you, that we're moving in a deglobalized world, not an increasingly globalized one. And right now, in the height of globalization, there was some unity in order to get everybody's revenue share up. But I think in a period of time, as we deglobalize, we're going to go back for every man for himself, and you'll start to see a rewind of a bit of things. Just the final thing, I mean, Claire, I mean, what with Dubai as a country, which countries do they compete with? Are they competing with Mauritius for investment into Africa? Are they competing with what, Luxembourg, Netherlands? You know, when people make a choice, when they're looking at Luxembourg, I mean, which countries are they really competing with?
Gosh, it's a difficult question. I'm not sure if there are any particular countries I could single out to say that they're in competition with. I think it's they're wanting to optimize people and optimize the business investment, the international investment into the country, but also they don't want that to be taking over completely, because they, you know, it's relatively, so the UAE is a relatively small country, but it's perfectly positioned in terms of the location and the relationships with Saudi Arabia. So it's a fine balance between making sure that they're attracting, you know, all the right sort of international investment and business, but kind of maintaining their identity. So it's I don't think there's any particular countries I could single out to say that they're in competition with, but it would be, you know, those entities that have got sort of attractive kind of tax regimes would be
And Lauren, I mean, Lauren, when you have your clients, do they think of like, do they go a little chart, Dubai, Mauritius? Do they have something like, you ever see anything like that?
Yeah, absolutely. We obviously always explore the various options for structuring purposes. So we'll compare the likes of Mauritius with UAE, and then also against your Netherlands, Cyprus, etc. It's often also down to what kind of business the entities are involved in. I mean, what are the exchange control regulations? It's not only always tax that we're looking at, it's tax, it's exchange control environment, things like intellectual property protection, etc. So it's a multifaceted approach to deciding where the most desirable location would be to set up business. And absolutely, we're still looking at your Mauritius, your UAE, Cyprus, Switzerland, Netherlands, you know, all of those are often in our analyses.
And look, I think location makes a difference. I mean, being nearby saves the money, but then it depends where it is. I mean, if you're talking UAE, it might be better to be closer to the source country versus the residency country from that. So on that note, it seems like it's a bumpy world. It's going to be a bit tougher for people going forward, but it's not insurmountable. And UAE realizes who their customers are, and they're doing the best to minimize the damage while being part of the main international stream. So we'll close on that. I think we're a little over an hour. So on that note, and we'll stay tuned for the next round, see who else pops off. Thank you so much, Lauren. Thank you so much, Claire.
Thank you, Keena. Thank you, Claire. It was great to chat.